In 2020, Warren Buffett surprised investors around the world. He invested in Japan's general trading companies. At the time, their price-to-earnings ratios were in the single digits. Their price-to-book ratios were below 1 for most companies. Many investors ask the same question: why invest in companies that are so hard to understand? But Buffett saw something different. Hello, I'm Shosha-man. I currently work as an active employee at one of Japan's 5 major general trading companies known as Sogo Shosha. I am not an analyst. I am not a former employee. I work inside this business model today. This internal, first-hand perspective is what sets this channel apart from most other investment-focused content. Back in 2020, Japanese general trading companies were clearly undervalued. Their PE ratios were in the single digits. Most traded below book value. They were large. They were complex. And for many investors, they were difficult to define. As a result, they had long been underappreciated by the market. But several years have passed since then. Following Berkshire Hathaway's investment, these stocks appreciated significantly. As global investors began to reevaluate the business model, valuations moved higher. Today, their PE ratios are around 15 times earnings. They are no longer, obviously, cheap. And yet, Buffett continues to hold them. At Berkshire Hathaway's 2025 annual shareholders meeting, he stated that he expects to hold these investments for the next 50 years.
In the next 50 years, and I hope he's running things then, we won't give a thought to selling those.
His designated successor, Greg Abel, went even further, saying they could be held indefinitely. This raises an important question. If these stocks are no longer cheap, why do they remain such high-conviction holdings? In general, diversified companies tend to trade at lower valuations. They operate across multiple industries. Their structures are complex. Their overall picture is difficult to grasp. Investors prefer simple, easy-to-understand stories. As a result, complex companies are often discounted. This is not unique to Japan. It is a global phenomenon. Speaking as an active employee, I can say this honestly. Even from the inside, it is difficult to explain what a general trading company is in a single sentence. We ourselves often struggle to describe our own companies clearly and concisely. That alone tells you how challenging it is for external investors to fully grasp the model. This is the key point. Japanese general trading companies are not simply collections of unrelated businesses. What matters is not what they do, but how they make money. Their business domains span a wide range: natural resources, food, energy, infrastructure, ICT, financial services, retail, and more. These businesses are not randomly assembled. They are connected through trading functions and long-term investments, forming an integrated structure. The profit structure of a trading house is not a simple sum of its parts. There is income from dividends, equity method earnings, and asset value appreciation. If that were all, trading houses would not look very different from other investment companies. But trading houses generate additional, continuous cash flow through daily trading and operational involvement. This two-layer profit structure is difficult to see from the outside. And because it is difficult to model, it is difficult for the market to fully value. Another critical aspect is how trading houses engage with management. They are not passive shareholders. In many cases, trading houses dispatch their own personnel into investee companies and actively participate in management and operations. They help redesign strategies, reorganize business portfolios, and integrate trading functions with group-wide operations. The goal is not merely financial returns, but to enhance the competitiveness of the underlying business itself. This approach differs fundamentally from typical financial investment. Buffett himself explained this perspective. During an interview when he visited Japan in 2023, he said that Japan's general trading companies were so much similar to Berkshire Hathaway. He was referring to their structure, the integration of investment and business operations, the emphasis on long-term cash flow over short-term gains. These characteristics closely mirror Berkshire Hathaway's own philosophy. It is true that trading houses are no longer cheap. However, that does not mean they are fully understood or perfectly valued. The long-term accumulation of cash flow is still difficult for markets focused on short-term performance to fully appreciate. Japanese general trading companies do not offer flashy growth stories. What they offer instead is steady value creation over time. That is precisely why, for long-term investors, they remain compelling even today. I'm Shosha-man. If this perspective from inside a Japanese trading company helped inform your investment thinking, please hit the like button and consider subscribing to the channel. In the next episode, we will explore the failures these trading houses have experienced in the past and how those painful lessons shaped their approach to risk management. Behind every durable business model lies a history of hard-earned learning. Thank you for watching. I'll see you in the next episode.